Looking at this income statement, we have usually in the income statements, this is, as we said, it's revenue minus expenses equal to the net income. Usually the revenue from sales, this is the nature of my business. I'm selling a product. So the revenue from this sales is equal to 650,000 dirham. Going down to the items that I can find on the expenses. We have to pay for advertising expense. We have to pay salaries and wages from the employees. We have to pay for supplies. So whatever we are buying in terms of supplies, office supplies, we have to use them. You have to pay for them. Depreciation expense. If you look at depreciation expense, we have two items on the depreciation expense. We have depreciation expense for building and depreciation expense for tools and equipment. These two are broken down into two parts for the simple reason. The useful life of the building is much longer than the useful life of the tools and equipment. So the depreciation expense will be smaller for building because it lasts for a long period of time. And the depreciation expense for tools and equipment, it is for a short period of time. We have to differentiate between the two. Utilities. We have to pay for the phone bill, we have to pay for the electricity, we have to pay for the internet. All of these are utility expenses that we have to think about. In our example, they cost around 70,000 dirham. Insurance. Insurance for the employees, insurance for the offices, and so on. And if we have a loan from the bank, that interest expense by itself is an expense that I have to pay. I have to deduct it from everything that I have on as revenue. I have to pay for it from the revenue. So the total expenses will add up to 404,000 dirham and 200. Revenue minus expenses will give me the net income. This is my take-home money from the operation into acoustic concepts. Let's now talk a little bit about the statement of retained earnings. Retained earnings, usually when we get to the net income, our take-home pay, we have to decide how much of that money will have to be reinvested in the company and how much of that money will have to be distributed in terms of dividends, for example. So starting on January 20 with a retained earning of zero, because Danny started the business on January 20, if you remember, during the year or during this accounting period, he generated a net income of 245,800 dirham. Out of these, he has paid dividends of 51,000 dirham. So the money that he has cashed in is 245,800. He paid 51,000 in dividends. So the company is left with 194,800 dirham at the end of this accounting period. That's on December 31st of the same year, 2011. So this amount retained earning is used as part of his capital, as his owner's equity into the business. He paid out of the net income 51,000, so he's left with 194,800 to continue his business. Let's move into this balance sheet to have an idea of the preparation of the balance sheet. If you look at the balance sheet, each and every item on the balance sheet is an account by itself that was in the ledger that we talked about before. We have the cash. This is the account for cash. This is the balance of the cash. It is 68,000. We have the account receivable, which is owed to the company. This is for services that we have rendered. We have the supplies, the office supplies, it's an account by itself. We have the unexpired insurance or the prepaid insurance. We have the land where the factory is established or the company is established. And we have the building. If you look at building and land, land does not have a depreciation expense. We do not use up the land. But the building, it is used up. That's why we have accumulated depreciation. It is a depreciation expense for each year that is added into the accumulated depreciation to see exactly how much the building is worth. So the net building value, it is 126,000. The building might have started with a higher amount, but with depreciation, it has been reduced. And we have tools and equipment. As we said before and as we've seen, tools and equipment are net of depreciation expense, less the accumulated depreciation. They are used up, and at one point in time, we might need to change them. Adding all these items on the assets, we have the total assets of 5 or 6,500 dirham. On the other side of the balance sheet, we have the liabilities and the stockholders' equity, or the owner's equity. On the liability side, look at the liability side. We have notes payable, we have the accounts payable, we have to pay for the suppliers, we have wages payable. The concept here of wages payable is that we are turning at the end of the year, on December 31st, we are turning in, closing the books, turning into the second period, and we still have some wages to pay for our customers. We did not pay it yet, so it is payable. We have interest payable. It might be the interest accruing or the interest that we have to pay for the loan that we took from a bank. So these are the total liabilities. These are amounts that are owed by the company. We have to pay them during the next period or the period after that. As for the owner's equity, we have the capital stock. These are the 300,000 dirham that Danny started with. As the retained earning, this is the remaining of the net income of the year 2011. After distributing dividends, this is the amount that is left into the retained earning, which is reinvested in the company. So Danny has now, as owner's equity, the 300 that he started with, and the amount left from the net income after paying the dividend. The total stockholders' equity is 494. Adding together the stockholders' equity and the total liabilities, the total is 506,500, which should balance with the assets. So on the balance sheet, we always have total assets equal to total liabilities plus stockholders' equity, which is 506,500. Once the financial statements have been prepared and the books are closed, it is time to get ready for the next accounting period. We have to know here that net income is earned over a period of time, during a whole year. So at the start of a new period, we want all revenue and expense account to have a zero balance, so we can start recording the income for the new period. So we have to close all accounts, to close all revenue accounts or expense accounts to start a new period fresh. So the closing of a company's books is a four-step process. First, we have to close all revenue accounts to a temporary account called the income summary. Here, we're introducing this new account. It's a kind of temporary or transitory account called the income summary. We close all the revenue accounts into the income summary. We close all the expense account into the income summary, and then we use that income summary account, the temporary account, and we have to close it as well. We have to remove all items that are into this temporary account. We close it into the retained earning account, and then we close the dividends into the retained earning. So we start the new year, we start the new accounting period, revenue is zero, expenses are zero, and dividends are zero. Income summary as a temporary account will have to be zeroed out by closing all this into the retained earning of the company. After the revenue and expenses accounts have been closed, and after closing trial balance that consists solely of balance sheet accounts is prepared. So now we cannot add the income statement account into the trial balance, because the revenue will have a zero balance, the expense will have a zero balance, So we have 0 on our net income. All we have is a balance sheet account. Revenue and expenses are into the retained earning, which is in the balance sheet account in the owner's equity.